Good morning, everyone. My name is Rob Anton, president and partner with Next Edge Capital. With us today is Mark Carpani, senior vice president and partner at Ridgewood Capital Asset Management, sub-advisor to the 2028 Investment Grade Bond Trust. The focus of today is I'm going to provide a little overview of the product, of the trust. What it was intended to accomplish, and then we'll pass it over to Mark to talk a little bit about Ridgewood Capital, his views on the market, as well as how he's set this portfolio up. So the 2028 Investment Grade Bond Trust was a fund that was focused a couple of primary focuses, but a finite term product. So it matures in March of 2028. And we'll go to cash at that point in time. And the focus of the trust was to, invest in what we see as a relatively rare opportunity to buy, invest quality, predominantly investment grade paper, ones at significant discounts to par value, which offers significant tax benefits. The portfolio currently is about 81% exposed to investment grade bonds, whereby the investment mandate has to have at least 75% in investment grade paper, and they do buy a little bit of high yield as well. But the minimum rated bond in the portfolio currently is BB. The fund does utilize some leverage, currently around 40% of the portfolio. That is used for two primary reasons, to both increase returns and improve tax efficiency, and I'll walk you through that in a second. The purpose of this slide isn't to say that we have a crystal ball and to say that we know the interest rates are going to be going down in the future. But we think it's, just somewhat prudent. And one of the reasons why we came out with this product at the end of, in December of last year, was to try to coax people or promote for people that are sitting a lot of their fixed income portfolios in very short-term paper, whether it be high interest savings accounts, 1-year GICs and the like, to maybe lock some of that portfolio into longer term yields while yields are still attractive. And, we still believe that, there's an opportunity here to lock in attractive yields, for a little bit longer. In our case, on this portfolio, there's 3 3/4 years left. The other thing I wanted to mention with regards to this slide here is just to, highlight the extended period that we went, over a decade plus of very low interest rate environment, and then the significant spike, of rising interest rate hikes, which caused these bonds to trade at discounts to par, which is an event that twofold. One, the starting point at which the hikes started from, as well as the aggressive and how fast the hikes happened, is a fairly rare event, which allowed these bonds to trade at discount levels that you typically don't see over the past number of decades, which creates an opportunity for tax efficiency. Illustrating the tax efficiency towards being able to purchase bonds at a discount. In this case, these are the example is on 5-year bonds, that all have a 7% yield to maturity. And you can kind of see on the after-tax yield, whether you buy a bond at a premium versus par versus a discount, the significant difference in after-tax yield for taxable accounts that it can make. In our case, our current portfolio has, an average weighted bond price of 93.25. And, as that 93.25 goes to 100, in the next, 3+ years, that's obviously taxed as capital gains, which is very tax efficient versus the coupon, which it pays out, which is taxed as income. There's quite a bit of benefits to that. With regards to the portfolio, we are targeting, and the reason why this product was launched is that we feel that there is, it still is an opportunity to lock in kind of an IRR over a 3 3/4 year time frame, that the product is around for. The current yield to maturity on the portfolio on a gross basis is 7.43%. So that's very attractive. Net of fees, that works out to be, a return of around 6.75%. And if you talk about interest equivalent yield, because of the tax efficiency, of which we expect about 40% of the fund's returns of those IRRs that I just mentioned to be from capital gains. The interest equivalent yield on the portfolio over the next 3.75 years is going to be in the mid 8% range. As far as how we achieve the tax efficiency, I did walk you through kind of an example on buying bonds at a discount and then them going to par, buying at 93.25, such as the current portfolio, and them moving to 100 will be taxed as capital gains. So that obviously has a benefit. And in addition to that, we utilize some leverage in the portfolio, which definitely adds some value. Number one is we definitely have a spread on our cost of capital that we're utilizing leverage on. Currently, about 40% of the portfolio is utilizing leverage. So we're picking up a spread of 250 to 300 basis points on the gross yield of the portfolio. But in addition to that, and just as important, or maybe even more importantly, is we're writing off the interest on that leverage against the interest income of the portfolio, and then using it to buy more bonds that are trading at a discount. So that actually improves the tax efficiency of the portfolio significantly. The current, estimation of, as of today on the tax efficiency of that return over the next 3.75 years is approximately 40% tax efficiency. The fund does pay out a distribution each quarter. It was set when we launched this product in December of last year at 5% based on the $10 launch price. The current NAV of the portfolio is 10.07, so that yield is fairly similar to that. And we will reset, announce the yield for the following year in December of this year. But our expectation is that we'll just continue to do it at 5% of the prevailing NAV when we announce that. Mark's going to talk a little bit more about Ridgewood Capital, but they've been a very impressive bond manager. They've won multiple awards, and in addition to being great people to work with, they have a number of portfolios that they run in the bond space. And the one that is closest to kind of what we're doing here is their investment grade bond fund, which has been around for over 14 years and, has significantly outperformed, bond benchmarks. We're talking like in excess of 3% compounded, and we'll show you that in a second. And lastly, with regards to how we structured the fund, as opposed to coming out with this fund as an open-ended vehicle, it's a little bit harder to lock in a tax, efficiency, on an open-ended vehicle. There's pros and cons to both ways. But by, matching the portfolio, the bond portfolio of the fund, similar in duration, or term, current term of that bond portfolio is around 3.44 years. And the life of this fund has, 3.75 years left. By kind of closely matching, the term of the bond portfolio to the term of the product, we kind of, you can lock in two things. One, locking in an IRR, till maturity, which we just talked about. But as well, we have, with a fairly high degree of confidence, we can give you a pretty good range of what the tax efficiency is going to be for those that hold this to maturity. And that's kind of one of the benefits there of having a fixed term product. On this slide, maybe you start off on the right-hand side on the pie chart. It really just goes to show you that what we're focusing on here in the bond portfolio is something that's, not too rated. Our portfolio, the lowest rated bond is BBs. And, if you can see this report done on over the last 41 years, whereby bonds rated BB or higher have made up only 1.5% of all defaults seen in bonds in the last 41 years, so fairly secure. And the chart on the left is more just something of opportunistic. You could probably look at many of these type of charts, but just showing that BBB bond yields, exceeded the S&P 500 earnings yield for the first time since 07 and 08. That Mark's going to talk a little bit more about the opportunity in front of us here. Lastly, before I pass it off over to Mark, We launched this product in November, December of last year, started trading on the Toronto Stock Exchange on December 21st. So you can purchase it, on the exchange. What we've done recently is we have with the regulators an at the market purchase program, which allows, and that's kind of why we're doing this call, is that, based on the prevailing previous day's NAV, we can guarantee fills for people wanting to buy this fund in the marketplace at NAV plus 2 cents. So the current net asset value of the product is $10.07. We post that to our website each day, and then subject to a 2 cent premium, which just kind of guarantees that we can't issue shares out of Treasury at less than NAV. It guarantees that if you want to purchase this product, you can either go into the market and pay a couple cents, above NAV, or if you can buy any on the market cheaper than that, go do so. But anyone coming in with size and stuff like that, we can organize crosses with National Bank, who's our market maker, was our lead on this product, and guarantee you fills. Management fee on the fund is 70 basis points. It is registered plan eligible, and will mature in March of 2028. And I talked about our distribution as well. And for those that don't like to hold a publicly listed security, just because you may see some volatility, although in the last 7 months or so since we launched this product, it's always been trading in and around net asset value. But for those that just want to buy this and put it away for 3 3/4 years and not worry about it and have it just show at net asset value, each month, there is a reorg option whereby each month you can actually move from the traded vehicle to a non-traded vehicle that just prices at NAV. And if you wish to actually convert back to the traded unit, you can also do that on a monthly basis. With that, I'll pass it over to you, Mark.
Thanks, Robert. So Ridgewood has been around since 2008, but prior to that, the investment team was together for a decade before that. So most of the people here, 25 years plus of market experience, analysts, portfolio managers, traders. So we're very comfortable with the team that we have. We've definitely seen a few market cycles. And the most recent one, I guess, with the pandemic has certainly been quite hairy. So I think that tenure and that experience has helped us. We're relatively small in as far as money managers is concerned, 1.4 billion, although that's not small, but compared to some of the larger firms, it's relatively small. But that's also, I think, an attraction for us as well as far as clients are concerned, and firms like NextEdge, because we're able to do things that other firms aren't, given our size. Most of our assets are in fixed income, as you can see, 1 billion. That's spread across institutional, private client, trust foundation, relationships with NextEdge, et cetera. And we'll talk about the track record on the next slide. So we were very pleased to be approached by NextEdge, and they talked to a few firms and settled with us. I think there was a meeting of the minds, not just on what we could bring to the table, but we'll talk about where we thought the best value was in the bond market. And they had an idea that was ironically looking very similar to some of the sectors and term structures that we were already overweight. So it was a really good meeting of the minds, last fall and going into the year end and Christmas. But here's just a brief record list of some of the awards that we've won in our various strategies. The Tactical Yield Fund being a more total return fund with a predominantly high yield with some investment grade. And then there's the Ridgewood Investment Grade Bond Fund, which this strategy more closely mimics as far as having predominantly triple B corporates. And then our sort of generic Ridgewood Canadian Bond Fund, which is more of a sort of a core type fund. So those are our three main strategies. We're very proud of the record of the work that the team here has done, and we hope to continue that in the future. Here's a long-term record. I won't go over each year, but we're very proud of this. This is our investment grade bond fund, which has been around for around 15 years. And, there's not every year we are successful, but we try through an investing cycle, certainly through, a 2 to 4 year period, that we want to be above the market consistently. That's how clients get paid, and that's how we get paid. So when we talk about fixed income, and I think NextEdge and ourselves agree with it, that last fall when we talked, we thought, well, this is a pretty good time to start to think about diversifying out of some cash and certainly out of some riskier assets. Equities have certainly done well. There's no comparison. The S&P, as you can see, relative to a 10-year treasury, has pretty much outperformed drastically over the last sort of 4 or 5 years, especially. So in our view, and certainly looking at the economy slowing and the central bank starting to cut, it's a good time to diversify away a little bit from some equities and certainly for some cash, and fix it into some short midterm bonds to sort of lock in that yield, but also to reduce the risk and volatility in your portfolio. So on the comment of slowing economy, so there's two data points here. One is the Bloomberg Economic Surprise Index. That's certainly more robust, but the Citigroup Economic Surprise Index has a very long history as well, and is a very good track record of cataloging all the high frequency data points. And what you can see is we are softening very, very rapidly in the economy, and the data is coming in much worse than what economists and analysts are expecting. And that's why you're seeing central banks globally cut rates, the Bank of Canada most recently, and the Fed likely will probably cut in September, if not sooner, but we're thinking September. This CPI data came in today in the US, and it was less than expected on a month-over-month and year-over-year basis. So we're starting to see things roll over, and that's really good for fixed income investors, particularly in the short end, which this product is focused on, because yields in that area, although they were high and everybody was happy in cash and GICs, et cetera, it's now time to sort of move out of that and fix that so that your reinvestment risk is eliminated. Next slide. So here's a brief overview of the structure of the portfolio. As Rob mentioned, we try to high grade as much as possible to keep the risk modest in this portfolio. Over 80% of the portfolio is in investment grade, and well diversified across many sectors and many names in the portfolio. Nothing really representing too significant of a weight, and also maturing over the next sort of 2 to 4 years. The bulk of it maturing in the 3 to 4 year period. So, I think, why did NextEdge do this, and why do we also love this in our portfolios? Triple B bonds are a great asset class, often overlooked. Investors still to this day, not all, but most still shy away from triple Bs, thinking, well, they're very close to getting into high yield. There's a lot of risk. I want to stay in the safety of just a generic Canadian bond or provincial bond, which is fine. And I think those have a place in certain portfolios. But we like triple Bs and have always been invested in them since the start of our firm, because we've done the work, and in managing these triple B bonds, they typically outperform in every market cycle. Certainly not every week or every day or every month, but over the long term, you can see that triple Bs relative to any sector in the universe bond market has pretty much outperformed. So that's why we want to focus on that sector. As long as you do your homework and diversify, it's very attractive to a fixed income or overall portfolio. And the next slide here is the same chart, but just high yield. So this portfolio, the NextEdge portfolio, does have a sleeve of high yield, just under 20%. That also keeps the risk profile of the fund high or medium, I don't know the exact, I think it's medium, right, Robert? Medium
Yes.
risk?
Yeah.
Right. So, but high yield is even more attractive. You can see that it outperforms every sector of the bond market by quite a wide margin. Obviously, you need to be much more diversified in high yield and certainly do your homework and monitor it very closely. And that's pretty much where we spend most of our day analyzing the triple B and the high yield credits. But over the long term, again, they're a great place in the portfolio, particularly in a buy and hold strategy. Kind of like think an analogy is like a small cap, you know, how volatile small caps are. As long as you don't have a significant weight, it's not going to force you to sell or keep you up at night when there's, you know, day-to-day, week-to-week volatility. As long as it's a good company, good name, you're going to get your money back. It's a great buy and hold investment.
I can jump here a little bit. We talked about this a little bit earlier. So we have committed to paying out a 5% distribution. That'll be reset each year. So that was 5% based, paid out quarterly and based on the $10 issuance NAV. Current price is 10.07. I don't think we can really pay higher than that just because the coupons on a lot of these bonds are lower because we're focused on purchasing, you know, a portfolio of bonds that are trading at significant discounts to par value. But we are committed to pay, you know, 5% for the life of that fund and reset that each year based on the prevailing net asset value. Mark talked a little bit about the term structure. And I think it's quite important, you know, and I'll bring it up now while we are on the slide, but, you know, one of the differences obviously between a fixed term product and what we're trying to do here with tax efficiency versus an open-ended product is that the average term of our, you know, bonds in the portfolio in this trust currently is 3.44 years. You know, if you had an open-ended vehicle whereby, you know, the average term might be 3.44 years, in a year from now, you know, our portfolio is going to have a term, you know, to maturity of maybe 2.44 years, whereas the open-ended vehicle may or may not, you know, change from the current level. So that's a key difference. You know, not saying that the portfolio is static, set it, forget it, but somewhat. That allows us to kind of confidently, you know, kind of portray a yield to maturity or an IRR till maturity, as well as that tax efficiency that we talked about earlier. Once again, yield to maturity 7.43% on a net fees basis. That's around 6.75, and on an interest equivalent yield based on the tax effectiveness of this vehicle, you're looking at mid-eights on the return. This is the returns of this portfolio since we launched it in late December. The portfolio is significantly, until we have a 1-year track record, we can't compare it to indices, but it has vastly outperformed peer benchmarks, you know, in the first 6 months or so of life. With that, I will we'll open it up to any questions. We do have a few in the queue. One that I'm going to start with is, you know, someone that asked, you know, for clarity, is it possible to issue treasury shares for the trust as for bigger buy, you know, tickets? Or does National Bank have an inventory that it uses for buyers? So, you know, with this at the money or at the market issuance that we filed with the regulators, we can offer up to $75 million of these units coming out of Treasury. The only restriction is that it has to be at a premium, or sorry, it has to be at par, and we put in a 2-cent cushion there just to make sure that we're not issuing it out at lower than par value. So that's the answer there. For any big orders, you can put orders in the, you know, in at your discretion, you know, in the market to buy this, but anything of size, if you wanted us to organize it across with the market makers at National Bank, either give myself or our respective salespeople across the country a call, and they can help you coordinate that. Another question we have here is the use of leverage. Is it being used similar to leverage credit mandate in an attempt to remove duration, you know, part to isolate credit spread, or is it straight use of investment margin from a prime broker? So We have locked in, obviously, on the initial portfolio, we locked in a cost of capital over the term of the fund. Obviously, as we raise more money, we'll have to lock in other rates, but there was a definite significant spread locked in between what the investment portfolio got invested at versus the cost of capital. In addition to that, one of the reasons that we did this as well was that we could improve the tax efficiency by writing off the interest of the leverage and use that to buy more bonds at a discount. So we got, the tax efficiency from maybe 25-30% to over 40%. So that was the primary use of doing that. The one question is just, the fund's been trading at a discount to NAV. If you had any comments on that, or if you guys have control. So we haven't really focused on marketing this fund up until recent, just because it wasn't available. It's available for purchase and it's fairly thinly traded. We're fairly confident that we're going to see a fair bit of money coming into this market and people take us up on this ATM offering. Anything that has traded at a discount to net asset value has been pretty thin. We have committed, on a go-forward basis that anytime that it does trade at a 3% or greater discount to net asset value, that we will support it and we'll buy up to 1% of net asset value each month. And that 1% each month gets divided up by the number of trading days, the month. So if it does trade at that type of a discount, we are in everyday buying. We have not seen that thus far to any extent. It's for the most part, I think in the first 6+ months, it's traded more at a premium than at a discount. And, I'll bring up the one point again that, if you did want to buy some of this, you can buy it essentially at NAV, and you do have the option to just switch it to the non-traded option, which just prices each month at net asset value as well. Are there any questions for Mark? Maybe Mark, talk a little bit while we have you on the line here, but I don't want this to go too long. Just about what you've done in this portfolio is allocated approximately how many names within the portfolio, and it's I don't know if you want to talk about any specific names, Mark, that you really like, but maybe just go a little bit further just into that portfolio composition and your thoughts on what was really attractive when you put this portfolio to work.
Sure. Yeah. There's I think just under 40 names. I would say are one of our favorite sectors back then, as it is now, not just in this portfolio, but in all our portfolios, is the financials. Financials have obviously been volatile, and they've had a bad rap when, in 22, when rates were rising, and certainly in 23 as they were settling back in, and, some of the earnings have been challenging in the financials. But looking out, say 1 to 3 years, when we're going to get a positive yield curve at some point. The banks are still making a lot of money, and their securities, particularly their subordinated bonds, were trading at deep discounts, very attractive yields, up in the sort of double B level of 7, 8, 9% when we were constructing this portfolio. We found that very attractive. So that's one of our biggest weights, and they've added a lot to the portfolio. I think they've probably generated a third to half of the alpha that we have in the portfolio. And I would say, your traditional, telcos. I mean, they've been very good, even though the stocks have not been great. I mean, we look at, at a telco. I mean, the earnings are very good. We're talking about a 3-year term or 4-year term. We're not too concerned about getting our money back from a blue chip company like that.
And I don't know the answer, but I'll ask you. But is there any U.S. issuers that are Canadian dollar denominated, and what are the restrictions there?
There are a few, but they're in Canadian dollars. They're categorized as maple bonds. So basically, like, for example, there's some insurance companies in there that are US based, but they do, their treasury does issue debt in Canada, in Canadian dollars for Canadian investors, and typically at a slightly wider spread. But they do that because they want to build their curve, diversify their maturities, their currency exposure, things like that. But very high quality, high up the food chain as far as, the credit stack, and low volatility. And, these bonds were issued sort of the last 2, 3 years at a deep discount. So they fit well on the profile of the fund.
And another question just popped in, Mark. Is there anything that you avoid in the Canadian and/or Maple corporate bond market?
Anything I'd avoid? A lot of the sectors are sort of doing very well. I would say maybe, a single asset real estate structure. I don't mind real estate per se, but as long as it's diversified. So we do have some commercial mortgage-backed securities in the portfolio, but it's not like there's 90% office in it. There might be 5% office, and 20% industrial, and 10% hotel, and 10% shopping mall, and then 20% multifamily, and 10% long-term care, things like that. So if it's a diversified structure, I like that. But I think if it was a single asset, unless it was full recourse or first mortgage, I would just be careful of that.
Great. Well, thanks, Mark, for the insight today, and thank you all for joining. If you have any further questions, please reach out to myself or your respective salesperson at Next Edge Capital. Thank you very much.
Thanks.